Everyone knows about Bitcoin cycles. Every 4 years, Bitcoin has gone on a parabolic run, increasing by hundreds or thousands of percent in a single year, and then it comes crashing down by more than 75%. This has happened 4 times since Bitcoin was created, and it's been like clockwork. But what if I told you that this time is going to be different? Well, I'm not only going to tell you that. In this video, I am going to show you exactly why this Bitcoin cycle is different from the previous cycles and why bear markets as we know them might just be a thing of the past. In this video, we're going to talk about 3 different things. First, in order to understand why this cycle is not going to have a traditional bear market, we need to understand how bear markets happened in the past. Second, we're going to look at 3 distinct reasons why Bitcoin is going to behave differently going forward, and we're going to look at a bunch of data to support this. Lastly, we're going to talk about how you can position your portfolio to benefit and make a lot of money in the coming years. Let's get into it. So, everyone's expecting Bitcoin to do the same old thing. It's going to go up like crazy and then come crashing back down, just like it always has. But I'm about to give you 3 key reasons as to why I think Bitcoin's going to go up significantly in the coming years, but without any major corrections. We'll start by looking at previous bear markets, which have a few things in common. The first is fairly self explanatory. For the first decade or so of its existence, Bitcoin had a relatively tiny market cap. For those that don't know, the market cap is simply the total value of all the Bitcoin. It's the price of Bitcoin times all of the coins in circulation. Assets with small market caps tend to be more volatile. A new wave of big buyers can push the price higher, and inversely, a new wave of big sellers can push the price lower. At the height of the 2013 bull market, Bitcoin had a market cap of just 10 billion. At the height of the 2017 bull market, it was about 300 billion, which is decent but still not massive. And it wasn't until 2021 that Bitcoin finally cracked a market cap of $1 trillion. But it did not hold that for long, as we had a bear market in 2022. However, this time last year, Bitcoin solidly broke the $1 trillion mark, and for the past 3 months, it has been holding steady at a roughly 1.9 to $2 trillion market cap. The reason this is important is because due to Bitcoin having a relatively low market cap in the past, it meant that the combined capital of retail investors was enough to move the market. In the past cycles, we didn't have Bitcoin ETFs, you didn't have dozens of public companies using Bitcoin as a reserve asset, and you did not have all of these institutions investing into Bitcoin. For the most part, it was just normal, everyday people like you and me. Even in the 2021 cycle, you had some institutions in the game, but it was still mostly retail. In fact, this was sort of the peak era of the retail investing craze. Everyone in America had a newly printed stimulus check. The whole Robinhood, GameStop, AMC saga was going on. It was retail mania. Now, the dominance of retail investors was a double edged sword because in bull markets, as the price went up, retail would FOMO in, pushing the price even higher. But during bear markets, they operated in reverse. The price would go down, and retail investors would panic sell, causing the price to go down even further. It's a cycle of retail investors FOMOing in and panic selling out. The low market cap combined with the emotional tendencies of retail investors created these massive bull and bear cycles. There's another phenomenon at work here too, and at Blockware, we call this energy gravity. Energy gravity is the idea that the Bitcoin price is affected by how much it costs miners to produce a Bitcoin. Here's what this looks like. When the price of Bitcoin rapidly increases, like in 2013, 2017, and 2021, there is a massive arbitrage opportunity in which it costs much less to mine a Bitcoin than it does to buy Bitcoin directly. Money goes into Bitcoin, Bitcoin price goes up, it becomes really profitable to mine. So, what ends up happening is the capital that was flowing into Bitcoin instead begins flowing into mining assets, ASICs, infrastructure for mining facilities, energy production, that sort of thing. And so this actually leads to the price of Bitcoin starting to come back down because you have less capital buying Bitcoin directly, while at the same time, more competition in the Bitcoin mining space drives up the cost to mine for everyone and results in miners having to sell more of the Bitcoin they mine to pay for their operating expenses. And all of these factors combined to pull the Bitcoin price back down, kind of like gravity. Now, let's take a look at this chart. What we've got here is the Bitcoin price in black. and a Blockware exclusive metric called energy mass in green. Energy mass is a measure of the average cost to mine one Bitcoin. There's a lot of dynamic factors that go into calculating this metric. We consider the average efficiency of Bitcoin miners at the time, the average electricity rate, etc. If you want to learn more about this metric specifically, I've put the link to a research report on the topic in the description. But ultimately, what we end up with is sort of the aggregate cost to mine Bitcoin. And when we look at the past bear markets, with each one of them, the price bottoms at the cost to mine almost to a T. Furthermore, we see a major disconnect between the price and the cost to mine at the bull market tops, which kicks off this energy gravity dynamic. The third component of previous bear markets is the macroeconomic liquidity cycle. And pay attention because this is super important and it's one of the primary driving forces behind Bitcoin right now. The chart we're looking at here shows the Bitcoin price here in orange, US dollar liquidity here in black, and the green and red areas show the year over year percent change in US dollar liquidity. The USD liquidity component is super important because this is half of the equation. Remember, we express the Bitcoin price as a fraction with USD in the denominator. Each of the past bear markets lined up with a drop in liquidity. And notice that liquidity appears to be bottoming right now. Keep that in the back of your mind because we'll reference this later. And if you take a look at M2, which is another way to measure liquidity, we are seeing a similar trend. And it was really exasperated in 2022 because this was the first year in which M2 actually had negative year over year growth. Dollars were quite literally being sucked out of the system. We all know the famous money printer go burr meme from back in the COVID days. Well, in 2022, it was money vacuum go burr. Dollars being sucked out of the system caused all asset prices to drop, not just Bitcoin. So now that we've looked at the major catalyst for the past bear markets, this gives us some perspective for the current cycle. And here's three reasons why I think we won't see a significant drop in the Bitcoin price going forward. We'll start with point number one, which is institutional investors. It's not retail in the driver's seat anymore. It's hedge funds, RIAs, pension funds, etc. Retail investors had enough capital to get Bitcoin from a $0 asset to a $1 trillion asset. But to get Bitcoin from 1 trillion to 5 trillion to 10, 20 trillion, it's going to require institutional investors, and they are here. Now, until very recently, Bitcoin was financial hearsay for institutions. They'd point to things like, oh, it's too volatile, governments are going to shut it down, et cetera, et cetera. Now, there's still plenty of that out there, but Bitcoin is now an option for institutional investors. Why? What changed? Well, three things. First, Bitcoin's market cap and trading volume are actually large enough to support institutional investors. Second, there's no longer a career risk for institutional investors recommending Bitcoin. Pretty much all of the top financial firms now recommend at least a small position. And some of them, like VanEck and Fidelity, are even predicting that Bitcoin will hit millions within the coming years. So while your average Wall Street jabroni probably still parrots many of the uneducated critiques, it's not totally out of the norm for an institutional investor to suggest putting managed funds into Bitcoin. They don't have to worry anymore about getting fired just for bringing up the idea. Thirdly, and this is the most important point, is that there's an increasing number of Bitcoin exposed financial instruments, offering investors varying degrees of risk and diversification. There's an ocean of capital within traditional finance that wants to get exposure to Bitcoin. But unlike retail investors, who can easily spin up an account on any of the exchanges, institutional investors require a more structured approach. Spot Bitcoin ETFs, derivatives to hedge, Bitcoin exposed equities, Bitcoin exposed bonds, Bitcoin company ETFs, trusted custodians, etc. Here's a good example to show you what I'm talking about. Goldman Sachs recently published their 13F report for Q4 2024. This is a report filed with the SEC that any institution with more than $100 million under management has to publish in order to disclose certain positions. In the filing, we see that across their asset managers, Goldman has more than $2 billion worth of the Bitcoin ETFs. But we also see that they are hedging some of that exposure with a put. They have a put option on more than a million shares of the Fidelity Bitcoin ETF. So the point here is that institutions can't just directly buy Bitcoin the way you and I can. It just doesn't work that way. But the good news is that they do want long exposure to the asset class. However, the financial plumbing and infrastructure needed to enable this at scale cannot be built overnight. Some of the tools they need are here. You've got the previously mentioned ETFs, MicroStrategy convertible bonds, Bitcoin treasury companies, but there are still a lot of products left to be built. Think Bitcoin backed mortgages, or ETFs of Bitcoin treasury companies, or Bitcoin exposure packaged with US treasuries. There's quite literally no limit to the amount of products that will get made in the coming years. And with the Trump administration giving the nod from a regulatory standpoint through things like SAB 122 and the Cynthia Lummis led Digital Asset Committee, institutions have been given a green light to start building these products. As these products are developed, more capital is going to pour into the asset class. The Bitcoin ETFs have only been out for a little over 1 year, and they've already attracted nearly 40 billion in total inflows. This is just one TradFi Bitcoin product, and we're going to see dozens more pop up during this cycle. And the thing about these institutional investors is they have more capital than retail investors, obviously, but they're also less emotional than retail investors. They're quicker to realize profits, unlike retail investors who FOMO buy when the price is going up. Institutional investors will sell after they see a decent return. After all, they're used to treasury bonds, which return 5% on a good year, so they're more than happy to take some chips off the table after a 50% return on Bitcoin. Moreover, they have clients and bosses to report to, so they'll happily realize gains if it means locking in returns for their quarterly or yearly numbers. So while this actually doesn't sound great and it could limit the velocity at which the Bitcoin price goes up, it also means there's support to the downside. This sort of approach from institutional investors means they're less likely to panic sell during dips. Moreover, institutions benefit from what's called passive capital allocation. Many Americans send a little bit of money to their 401k or IRA every time they get a paycheck. They're buying assets regardless of the price. Traditionally, this has been a 60-40 split between stocks and bonds. But now, as institutions have the go ahead to allocate into it, Bitcoin will benefit from this passive allocation. The data already supports this idea. Since the launch of the Bitcoin ETFs, we've seen a cycle of Bitcoin going up by roughly 50%, followed by months of consolidation with much smaller peak to trough dips in the 10 to 25% range, nothing close to the 75% drops of past bear markets. This chart here shows the percent drawdown from all time highs in red and the year over year change in the Bitcoin price in green. You can see the massive moves up and down in 2017 and 2021, but since early 2024, when the ETFs were created, you see this new regime of steady growth in the Bitcoin price, denoted by this green area down here, with only mild drops from the highs, as denoted by the red area up top. Price growth is less explosive, but the drawdowns are nothing in comparison to past bear markets. The second thing that's different this time around is that altcoins are dying. Bitcoin dominance, which measures Bitcoin's share of the total cryptocurrency market cap, is at roughly 60%. Moreover, Bitcoin dominance has been straight up since the collapse of FTX in the bear market bottom back in Q4 2022. The reason this is important is because altcoins have historically been viewed as a way of getting leveraged Bitcoin exposure. But we're in the middle of a bull market. Bitcoin's at $100,000, and this has simply not been the case. For example, Ethereum, which is the second largest crypto after Bitcoin, has not even broken its 2021 high. Instead, what's happening is investors who want higher beta Bitcoin exposure are looking to Bitcoin treasury companies such as MicroStrategy, Semler Scientific, and others. And this has worked very well. These stocks have outperformed Bitcoin over the past year, doing exactly what investors hoped they would do. Altcoins, on the other hand, have not. When Bitcoin's gone up, they've gone up less. When Bitcoin's gone sideways, they've gone down. And when Bitcoin dips, they've gone through total carnage. For better or worse, we're seeing the altcoin space transition away from the idea that they offer some kind of tech or utility, and they're going to full blown memes and casinos, which, in my opinion, is better because now they're at least being honest. With the rise of Solana meme coins, Trump, Melania, Javier Milei launching their own meme coins, The reality of what these other cryptos are is really obvious to anybody paying attention. And in previous cycles, the volatility of the wild, wild crypto West exacerbated Bitcoin bear markets. But now that a lot of the speculative capital is going into these Bitcoin proxies instead of altcoins, that's going to bode well for Bitcoin. The third and final reason why I think Bitcoin bear markets as we know them are over is because of the current macro environment. The United States is backed into a corner because of the massive spending deficits they've been running over the past 2.5 decades. And while Trump and Elon are adamant that they'll get spending down through Doge, the reality is a large portion of the budget simply cannot and will not be cut. Entitlement programs like Social Security, Medicare, plus interest payments on the debt make up the vast majority of government spending every year. So even if they make cuts to some of these three-letter agencies, which I'm all for, by the way, they're going to continue operating in a budget deficit. What does that mean in the long run? Inflation. That's right. When governments dig themselves into a situation like the one the United States is in right now, with debt to GDP over 120%, keeping inflation higher than interest rates is the go to game plan. Slowly inflating the debt away over multiple years or decades. Trump and the new Treasury Secretary, Scott Bessent, are not exactly keeping this a secret either. They've talked multiple times about how they want to get long term US interest rates down. Moreover, everything Trump wants to accomplish a roaring stock market, economic growth, more domestic manufacturing is going to require a weaker dollar, which will bode extremely well for Bitcoin. You need to look no further than the US dollar index, the Dixie from Trump's first year in office of his first term, to see what's going to happen. We're going to get a weaker dollar, rates will come down, and money is going to be printed. It'll likely be more gradual, unlike the massive printing spree from 2020, which caused a huge spike in inflation. This gradual rise in liquidity is going to be amazing for all assets, but specifically Bitcoin because it is the most porous sponge of global liquidity. Let's take a look back at our chart from earlier. You can see here that liquidity is definitely bottoming out right now, and the rise in liquidity that's coming over the next couple of years is going to keep the Bitcoin price from having any major corrections, especially now that it's easy for institutions to move that liquidity into Bitcoin. Okay, so we've covered three reasons why I think this cycle is different. To recap, one, you have institutional investors. Two, altcoins are dying. And three, liquidity is on the rise. So now the question that's on your mind is, how can I use this information to make a return? Well, the simple answer is that you can buy and hold Bitcoin. And this is a great option. But what if I told you that there's another way to accumulate Bitcoin? It's called Bitcoin mining. Rather than buying Bitcoin directly, mining allows you to accumulate Bitcoin over a long period of time. And miners often end up with more Bitcoin than if they had purchased Bitcoin directly. In fact, from 2020 to 2024, Bitcoin mining outperformed buying Bitcoin directly by more than 300%. Typically, when people think of Bitcoin mining, they think of that one guy they knew who used to have a bunch of big noisy computers in his garage. But the industry is a lot more mature these days. The most profitable Bitcoin miners on the planet have their machines running at top tier data centers, operating with extremely low power rates and run by world class professionals. Blockware's mining as a service enables anybody to start mining Bitcoin at one of these data centers without lifting a finger. Blockware has the latest and greatest Bitcoin miners hosted at our data centers, and they're available for purchase right now. When you buy one of these miners, Blockware handles all of the day to day operations and maintenance. You cover the electricity costs of the machine, and in exchange, you receive all of the Bitcoin that that machine earns. It's simple, effective, and it has helped thousands of investors, both big and small, get into Bitcoin mining. You can even visit marketplace.blockraresolutions.com, where you'll find hundreds of machines that are available immediately. If you click on a machine, you'll be presented with everything you need to know to make an informed decision: how much Bitcoin it mines, how much power it consumes. You can see its historical uptime, so you know if it's been working properly. You can see which facility it's located at, the serial number, everything. For more information, click the link in the description or go to mining.blockraresolutions.com/info. Here you can get in touch with our team and we'll create a personalized strategy to help you achieve your Bitcoin goals. Make sure to like this video and subscribe to the channel.